Strategist at Standard Chartered Bank. Abhilash, good to have you with us here. Thanks very much. Markets in the US are repricing themselves to anchor themselves to much higher rates, Abhilash. So the environment for equities once again is a bit adversarial, isn't it?
Yeah, absolutely. And I mean, if you look at the market reaction in US over the past 1 month, it's starting to smell like a classic overreaction. Just 1 month back, markets were cheering that inflation will be lower than expected. Markets had priced peak Fed funds rate all the way to 4.85. 10-year yields were at 3.3%. And what's happened in just 1 month, based on just 1 month's data, we've seen a complete repricing of the curve. 10-year yields are at 4%. And if you look at market expectations of Fed funds rate, they've priced in 3 more additional rate hikes. And just based on 1 month's data, that seems like a bit of an overreaction. So we could see a correction coming through in the yields in the coming few weeks, I think.
There's still this interest rate fear, right? I mean, the hike in interest rates are not done just yet. So I guess that's creeping into the bond yields too. And in equity markets too, there is no conclusive recovery, especially in markets like India. What is your prognosis now?
Yeah, I think obviously we've seen that negative correlation come through. So we've seen bond yields rise, people getting concerned about tighter monetary policy. So a very similar sort of setup that we saw for bulk of 2022, especially in the global market context, and that's been weighing on equities. But I think the other key driver, which sort of goes beneath the surface, is when you look at earnings expectations in US and Europe, they have been consistently revised down over the past few months. And we think that, there is further downside to earnings for US and European equities, and that could continue to weigh on the global equity market. Obviously, in Asia, we are a bit more optimistic, so we think that earnings will be a bit more resilient in Asia, but obviously the global market trends would be a key headwind for Indian equities.
Hi, Abhilash. Morning. In the past, you mentioned that you'll be tilting toward China versus India, Indian markets owing to valuations. You're still holding on to that thought? And also, I recall, we were discussing about emerging markets. Most of the central banks, they have moved faster. But what about the RBI? You believe there are more rate hikes even here in India?
Yes, so I think maybe let's start with the China question. So we are still overweight on China within the Asian equity context, and we are neutral on India. And I think the latest data that we saw from China sort of justifies that stance. So if you look at the manufacturing PMI data that came out in China just yesterday, was the highest reading that we've seen since 2012. So it's seeing a very strong rebound based on the reopening that we saw just a few months back. And we continue to think that investor inflows into Chinese equities would lead them to outperform in the next 1 to 3 months at least. As far as India is concerned and RBI, we think that the latest inflation upside and the potential for increase in food prices because of hotter than expected summer could lead to one more rate hike from RBI, so peak at 6.75. But we think that once 10-year yields reach 7.5 to 7.75 range, that would be a great opportunity to start adding to bonds.
Okay, all right. Thanks a lot, Abhilash, for joining in and giving us a quick update on what you expect as the way forward for global and local equity markets. Well, caution is still the name of the game. And, we're not out of the woods just yet. That seems to be the summary. But he's more optimistic, of course, on Asian markets, especially markets like India. Let's step into a quick break. Lots of stocks to talk about. So our list of top 10 stocks is coming up in minutes from now.